right, so let's talk about those individual cues then. Let's start off with the listing, Campus Activewear. That is listed at a premium on the exchanges today. Mangalam is here to tell us more about this new kid on the block. Mangalam.
Well, it's a good listing for Campus Activewear. It is a shoe company and it's listed at a premium to what its issue price was. 292 was the issue price. The stock listed at 360 and is currently around the 340 mark itself. The market cap crossed that 1,000 crore mark on listing day. 10,000 crore mark on listing day, beg your pardon. And as we speak, it's closer to that 11,000 crore mark as we speak. The stock trades at 111 times FY23 price to earnings, closer to 9 times FY23 price to sales as well. So that makes it trading at a premium to all the other listed footwear companies on the bourses, including the likes of leaders like Bata as well as Relaxo, which incidentally has the highest market cap in the footwear industry right now. Why is that? Because, well, it is the largest sports and athleisure footwear company in the country with a 17% market share. A large part of their revenue, nearly a third, comes in from online players, and nearly two-thirds, a little more than that, comes in from tier 2 and tier 3 towns. So while they do have a fair amount of advantages and significant brand recall, how do they navigate through the competition is something that the street will want to know. And more importantly, the management was targeting 1,800 crores or doubling of revenues over the next couple of years at their current capacity. When does that come by is something that the street would like to know.
Thanks, Mangalam, for highlighting that. In fact, let's pose these questions. We are now joined by Nikhil Aggarwal, the Chief Executive Officer of Campus Activewear, on the show. Nikhil, morning. This is Reema here, and congratulations. In a weak market, when the sentiment is weak, Campus Activewear has had a very good listing, so congratulations on that. My first question is, on this target of 1,800 crore in terms of revenues, when will you achieve it? Will it be in 2 years? Will it be 3 years? Could you give us some indicative timelines?
Sure. No, thank you, Reena, firstly, for such a warm and well wishes from your side. We are super elated for this kind of response. In this kind of macro environment, it's actually quite challenging. But we are really proud that we are the first Indian sports and athleisure listed entity in India, and it makes us really, really happy to be that. In terms of our, I would say, future prospects, so we have a very, very strong track record of the last decade. If you look at, the numbers, we've grown at 27% CAGR over the last 10 years, in spite of COVID, including the COVID year. So while I cannot certainly give you any sort of guidance, unfortunately, about the next couple of years, but what I can tell you is that being the leader in this industry by far, there is no reason that we should, grow slower than what we have already demonstrated over the last 10 years, right? And at that point, we were not even the leader, right? Maybe 5-6 years back. So I hope that sort of answers your question.
Can we say revenue growth for the company would be about 25-30% annually for the long term?
Certainly. I mean, we have grown at 27%. So exactly what I meant is that there is no reason that we should not grow faster than this, what we have demonstrated. And, we are very strong in our all our core markets and even non-core markets now over the last 3-4 years. Given that we have the largest distribution base in the country, physical distribution of more than 400 distributors and almost 20,000 retail outlets that we cover. Apart from that, D2C online is doing really, really well for the brand. So we are a true omni-channel brand today, right? Apart from that, we also have the strongest vertically integrated manufacturing ecosystem, which is the largest in the country. And if you top that up with our brand recall and the brand equity that we have invested in with our design and development, we are truly a class apart within this industry, and I'm sure you'll see that when we declare our results in FY22 by May end.
All right. Hi, Nikhil. Good morning. Thanks for joining us, and congratulations on what has been quite a solid listing. On your market share, you have around 17% in this branded sports and athleisure footwear category. How much do you see this increasing to, and what is the kind of timeline that we can expect?
So last 4 years or so, we have been increasing our market share by almost 1 to 1.5% each year. This has been the trend for the company. The overall market is close to 12,000 crores today in sports and athleisure. So about 55% of that market is roughly is organized and 45% is unorganized. So we command about 17% share today in the organized end of the sports and athleisure segment. If you couple that with another 25,000 crores to 30,000 crores of casual footwear market that we also operated now, so the overall addressable market for Campus becomes close to 40 to 45,000 crores today. So we have been basically gaining about 1.5% share for the last 4 years.
Hi, Nikhil. Morning. I understand that the bulk of your sales come from tier 2, tier 3 cities, etc. So what will be the driver of the next leg of growth for you? Do you have scope to offer some sort of premium products, high margin products? How do you look to diversify from here?
Sure. So 2 or 3 things have actually happened for the brand in the last couple of years. So one is that we were always a tier 2 and 3 focused, very, very strong brand. We almost monopolized the tier 2 and 3 markets in a way. But lately in the last 3 years, we've also had a significant contribution from metro and tier 1 come in, which is almost close to 25% now, and 75% is tier 2 and 3. If you couple that with the consistent premiumization that the brand has done over the last couple of years again, we've grown our ASP at almost 8% CAGR, over the last 4 to 5 years. So there has been a significant drive in both premiumization and the metros and tier 1s of India. And the basis of that is the value proposition that we're actually providing in our products. Our audience, the end consumer, is really, really excited when they enter one of our EBOs, or they go to an MBO and they look at the kind of expansive range and the quality, the look, feel of the shoe that we are providing, which is very similar to the MNC brands, but at a fraction of the cost. So basis, this kind of excitement, this is why, we've been able to gain this kind of market share. Of course, with this kind of reasonably priced shoes, we obviously maintain our margins, which is very, very important to all our stakeholders. So all of this comes at the back of, a minimum margin, contribution margin that we operate with.
EBOs are exclusive brand stores, while MBOs are multi-brand stores, for the benefit of our viewers. One final question then. Your gross margins are above 50%. Can you improve it from these levels?
Sorry, come again, please.
Your gross margins. Is there scope to expand gross margins?
Yeah. Absolutely. So there are a couple of levers that have been working for the company in terms of margin expansion. Again, we have grown our margins by almost 1 to 1.5% every year for the last 4 years. So we were, our gross margins were somewhere around, mid 30s, which has gone up to about 42. So our material margin is actually 52%. I'll just make a small correction there. Gross margin is almost 40%, but the actual overheads, that come after the gross margin line is very much in control. So therefore, we end up at almost 20 to 21% EBITDA, finally leading to about 10 to 11% PAT levels, right? So this is, and we've seen consistent, margin expansion over the last 3 years by 1 to 1.5%. And this is basis, the channel mix firstly. Given that the D2C online channel is performing much better and faster, growing faster, so we have actually a better margin, contribution coming in from D2C. You couple that with a lot of the backward integration that the company has done in the last couple of years with our own sole plants and our own upper plants. There again, we have a significant savings coming in. And thirdly, the ASP that has been increasing for the company, the premiumization that we have done. So there is some benefit coming in from there as well. And going forward as well, we don't see any reason why, these levers should not benefit the margins further from here.
But you're not giving us a level, Nikhil. You said it's 20 to 21% now. How much could it go up to?
I'm sorry. I'm not at liberty to say that as much as I would like to tell you guys. But what I can tell you is that we have grown at 1 to 1.5% year on year, right? So that's the track record. It's a pretty strong track record, and no reason why we should not deliver on that again.
Okay, I'm sure the street will like the sound of that. Thanks a lot, Nikhil, for joining us and taking us through your outlook for Campus Activewear. The stock has seen an even further up move after its listing, so it's currently trading well in the green, 28% higher. But that's on Campus Activewear. We'll slip into a short break now. You don't go anywhere. We're going to shift focus and discuss the world of commodities when we come back.